Welcome back, students who are taking financial accounting, and in this series of videos we are working on the Chapter 5 short exercises. And we had left off on problem 5-8, so we're going to pick up with 5-9 and realize that these short exercises are kind of covering the various concepts and of course application. If you're not understanding the concepts, then go back and reread the textbook. Some of these things like in 5-8, I didn't go through in the video what materiality is and things like that. That's in the textbook. The videos are not meant to be a replacement for the textbook. Okay, it's only a supplement to it. And if you're rereading the textbook and you still don't get it, and you're still not picking it up from the videos, then contact an instructor, because you need to understand the concepts before you can apply the information. Okay. Right, so lower of cost or market. All right. Assume that Bob's boards, I hate these names, is the following LIFO perpetual inventory. Okay, LIFO perpetual inventory record for skateboards for the month of March. Okay, so this is the LIFO perpetual method. At March 31st, the account for Bob's boards determines that the current replacement cost of the ending inventory is $10,640. Make an adjusting entry needed to apply the lower of cost or market rule. Okay. Inventory should be reported on the balance sheet at what value on March 31st. Okay, so before we can make the adjusting entry, we have to figure out what the value should be. So if our books are showing that it's 10,800 and the replacement cost of the inventory is 10,640, right? The difference between the two is $160. So we're going to adjust our inventory to down because it's overstated, right? It's 10,800. That's more than 10,640, so we're going to adjust it down. So if inventory is an asset, right, and we know we increase our assets on the debit side, but we're decreasing the asset, right? So we're going to decrease it on the credit side. So we're going to have to credit our inventory for the $160, right? And of course, debits have to equal credits, so you have to put that someplace else. And since we're decreasing that, our inventory, we're increasing our cost of goods sold by $160. Okay, and it was really just that simple, right? It says here, and I just glanced up, inventory would be reported on the balance sheet at what value on March 31st. So on March 31st, our inventory value should be 10,640, okay, not the 10,800. Next problem, next exercise. Reporting, let's see, at the end of the current year, Cottage Cafe's inventory account balance was $13,550. A physical count of the inventory revealed that the inventory on hand was $13,480, right? So our books are showing $13,550, and the physical inventory says we should have $13,480. What amount should Cottage Cafe report on its balance sheet for inventory? Okay, you always adjust to your physical. Boy, oh boy. You'd think I didn't go to school, right? Physical inventory. Okay, you always adjust to your physical inventory, right? That is what is written in stone. All right. Sure, during the at the end of an accounting period, you're going to take a physical inventory. If you're supposed to have, if your physical inventory is 13,480, that's what needs to be shown on your books. Okay. it's the basis, because what ends up happening is if you don't adjust your physical inventory, then you could be inflating your inventory or deflating it, which means you're expensing too much. And also realize, take into consideration, let's say we'll talk about let's talk about, I don't know, cartons of eggs, okay, instead of milk. All right, you can have, you can say in your freezer, you have $13,480 worth of eggs in there, okay? But remember, you had a beginning balance in the freezer, in that refrigerator, and then you made purchases, right? And you made more purchases, and you made more sales. Well, you could probably, is it possible for you to accurately record every purchase and every sale? Yes. But what happens when somebody drops one of those cartons of eggs? Okay, and now that's a loss, right? What if somebody steals one of the cartons of eggs? That's a loss. You don't have any way of recording that because you didn't get any, no transaction occurred where you purchased or you sold, and you have a receipt or an invoice for that purchase or sale. Okay, so merchandise can go bad, it can get stolen, it can break or whatever have you, and you can accurately keep on your books. You can try to accurately keep on your books what's happening with the inventory. In the case of like specific ID, where you're looking at automobiles, that's very easy to keep track, and because that the car isn't going to break and it's not going to get stolen. I mean, it can get stolen, but most likely that doesn't happen. But in like a grocery store, even though you're recording purchases and sales, does not accurately reflect what your physical inventory actually is. And you always want to use, one of the bases is actual, what is actually happening in the business. And that is what happens when you look at your physical inventory. So even though I recorded all of this, maybe, maybe my books say I should have 13,550, right? But the difference between these two is $70. Maybe $70 worth of eggs were broken, stolen, or whatever have you. I have no way of being able to account for that. So my books would always be showing this, but that's overstated, okay? And that means, I haven't taken out, I haven't expensed that $70, which also means I haven't paid, my profit was greater than it should have been, and I ended up paying more tax than I should have, okay? So you always adjust to a physical inventory, right? All right, let's see, 11. All right, again, here's the concepts, okay? I don't know the definitions, I understand the concepts, that's what's important. All right, so match the accounting terms, so we're going to do matching, okay? Number one, assigns the most recent inventory cost to ending inventory. That for me would be conservatism. Results, and why is that conservatism? Because we're using our most recent inventory costs, okay? We're not inflating or deflating, all right? If I used the oldest costs, I wouldn't be as conservative, right? I'm not being as, I'm not representing them in the correct light. It results in cost of goods sold that falls between FIFO and LIFO produce, assuming rising prices, right? Let's see here. Results in cost of goods sold that falls between FIFO and LIFO produce what FIFO and LIFO produce, assuming, okay, forgot the word what. Right? Results in cost of goods sold that falls between what FIFO and LIFO produce, assuming rising prices. Okay, so that would be consistency, right? This principle is the basis for using the lower of cost or market rule, right? That would be Let me back up here 1 second. That would be, let's see here. Okay, that would be G, materiality. All right, now I'm not going to back up. Principle that prevents a company from using a different inventory costing method each year. That would be B, full disclosure. Identifies exactly which inventory item was sold. You know what? I'm going to back up here. Start all over again. I just happened to glance down at the solutions, and I do not agree with the solutions in the solution manual. As I'm going along here and I'm thinking, okay, what's this, what's that? I don't agree with them. All right. So, I mean, in the solution manual, I had C, F, G, B, A, D, H, and E. Okay. I'm actually going to work through these the way I know, because I don't agree with these solutions. All right. So let me start here. The principle that states significant items must conform to GAAP. That would be materiality, G. Treats the most recent, newest purchases as the first units sold. Treats the most recent units, newest units as it. Okay, so that's last in, first out. So that would be C. Requires that a company report enough information for outsiders to make decision. That would be B, full disclosure. Identifies exactly which inventory item was sold, usually used for unique inventory items. That would be H, specific ID. Principle that prevents a company, let me get rid of that, get rid of that, get rid of that, get rid of that, okay. So principles that prevent a company from using a different inventory costing method each year. Okay, so that would be F, consistency. This principle is the basis for using the lower of cost or market rule. A. No, wait, I'm going to skip that one for the moment. Now, it results in cost of goods sold that falls between FIFO and LIFO produce what FIFO and LIFO produce, assuming rising prices. That would be D, average cost. And I thought this was conservatism. And then, of course, then that makes this one assigns the most recent inventory costs to ending inventory. So that would be FIFO. And so, as you can see, my answers are different from those in the book. Okay. As I was going along, it's like, geez, that doesn't make sense. That doesn't make sense. So I decided to pause the video and take a good hard look at it. And these are the answers that I've determined for 5-11. I don't agree with the answers that are in the study guide. I'm sorry, in the solution manual. But that is as it'll be. Okay, so as long as you like I said, it's good to understand the concepts. You're not going to be asked for them. You're not going to be asked to memorize them or whatever have you. So just get the general gist of what they are. It's more important to be able to use the concepts than it is to be able to regurgitate them. With that said, I'll move on to 5-12 in the next video.